Well, we're very pleased to see that the projections we had for much higher real GDP have come through. I mean, the numbers were very important. The U.S. came in with 12% real growth. So did Japan at much higher. Italy, 19%. The U.K., 22%. And that did translate into much higher sales worldwide, 25 to 35%. And so we had very important earnings growth, 90% in the US, 240 in Europe, 190 in Japan, everywhere really but China, which had already recovered. And it meant that the high valuations that we discussed last time, really just a few weeks ago, are much less stretched just because the earnings growth has caught up. So it is really quite positive in terms of the global recovery out of the COVID-19 global recession. And it has really, contributed to extreme differences in performance. Let's face it, some markets are up, commodity markets, the US equity market are up 20%, and you've lost money this year on gold and on bonds. So it has made a big difference to those who allocate assets around the world.
You talk about valuations. I'm just picking through your list and you flag up some very expensive markets. You say the United States fits into that category, is very expensive, Asia ex-Japan. But you also then indicate that Japan's neutral along with France, and then inexpensive, and that's a category that catches my eye, inexpensive, the United Kingdom, Sweden and Italy. Does that mean you're looking to allocate to those inexpensive markets on a catch-up trade?
Not necessarily. Inexpensive markets are always interesting as long as they're going to go up. And you can stay, what is it? There are a couple of maxims out there about how they can stay down longer than you can stay solvent. What's interesting is whether or not those countries are going to participate in the global recovery. Will that recovery continue over the next couple of months? And will it mean that we're going to get a justification for earnings expectations of really, for the next year, they're looking for about a third, 33% in the U.S. Earnings growth, probably everywhere around 25% earnings growth at least, and whether or not that's going to come through and whether or not we should allocate there or not. I think that the undervalued, regions of the world in particular would be emerging markets, things like Brazil, like Mexico, even India's neutral valuations. They haven't participated quite as much as the rest of the world in this kind of recovery. And I'd say it does look through our models in any case that there is more to come in terms of growth and output and relatively stable prices over the next several months. There will be other, let's put it this way, considerations to take into effect. I don't think the global situation is as stable as it was up until a month or two ago, and that we're going to have more volatility coming from there, and it may not be as favorable to emerging markets as might have been the case otherwise. So I don't think that we're looking for any major differences or places to allocate away from. The other thing I'd say about the U.S., which is by far the most expensive market, it has to do with the size of the U.S. capitalization. They're 61% of world equities, 4 times bigger than the entire European capitalization or the Asian capitalization, 16 times emerging markets. It's very big and very concentrated you've got nearly a third of U.S. cap in 6 or 7 stocks. It's the major, let's see, it's Apple, Microsoft, Amazon, Facebook, Alphabet. That's really what's been driving, and those companies in particular are very highly valued, which makes the U.S. look very highly valued at present.